Welcome to Stock Therapy with Penny Queen.
Happy weekend to all those who celebrate. This video is going to be a little bit different as I'm trying to add a little more educational content to give people a better understanding of how stocks are actually trading. Today we're going to talk about Fibonacci levels and also options trading. I'll be using Aduro Clean Tech as an example. It is a stock that recently had a sharp pullback that spooked a lot of traders, but also created a textbook Fibonacci setup and a great lesson in how options can turn volatility into opportunity. Before we talk about options, I want to show you how Fibonacci retracement levels can help you make sense of a move like this. When a stock rallies and then starts to fall, Fibonacci levels help you identify where the fall might slow down or reverse. And there's some very typical numbers. We use 38.2%, 50%, 61.8%, and 78.6%. These aren't magical numbers, but they represent the natural ratios that show up in everything from tree branches to financial markets. On Aduro's chart here, you can see that the price ran up to around 1766, and then it dropped to 1277. That is a 28% pullback. But when I plot the Fibonacci retracement from the high to the recent low, the reversal started right near the 78% level. That's what traders call the golden pocket, and it's often where the panic ends and patience pays. Now let's talk about how options fit into this. Options are basically side deals on a stock. They give you the option to buy or sell at a fixed price within a set time. If I buy a call, I'm saying, I think this stock will go up. But the real beauty is leverage. Instead of spending $10,000 to buy 1,000 shares outright, I might spend just a few $100s on a call contract that controls those same shares. So each contract usually represents 100 shares. So even a small move in the stock can mean a big move in the options value. The catch is timing. If the stock doesn't move before the expiration, the options value fades fast. That's why I only use options when I really understand the company and the catalysts I'm waiting for. With Aduro, I believe the story isn't finished yet, and that's where strategy replaces emotion. So now that we've talked about retracements, the pullback where support formed, let's look at the other side, Fibonacci extensions. Now, these levels project potential upside targets based on the size of the previous move. So starting from the swings low, that was 1277, and that high around 1766, the extension shows us where the next wave could go if momentum continues. So at the 1.0 level, that's about $20.50. That would be a full measured move, the same size as the last rally. So then that 1.272 and 1.618 levels, that's around $22 and $25. That's a mark where a lot of traders will often take profits or where the next surge could accelerate. So right now I'm really focused on that 1750 level as it's a realistic first target. It's a Fibonacci midpoint, a round psychological number, and it lines up with Aduro's real-world catalyst, the commissioning of their next generation process plant. So this is what makes this setup interesting. It's not lines on a chart, it's structure meeting story. All right, now this is where the options come in. Option prices move much faster than the stock price itself, both up and down. When the stock was down around $13, RSI was in oversold territory, and sentiment was at rock bottom. That's when call options were dirt cheap, what I call a screaming deal. Traders who recognized that Fibonacci support zone and believed in Aduro's catalysts, they could have picked up calls for a fraction of what they're worth today, just a couple days later. Now, those contracts would now be very profitable, even though the stock hasn't yet hit those targets. So let's look at where we are now after a healthy recovery, and I'll use the prices that are currently available. Suppose I have $1,750 to trade. That's roughly enough to buy 100 shares at $1,750, but instead of owning 100 shares, I could use the same money to buy a call option. Contracts that give me the right to buy the stock later, but at a fraction of the upfront cost. I've heard people call this a layaway plan, but you don't necessarily have to buy it. You can sell those same options. You do not have to exercise them. So if I chose the $15 strike calls, which are closer to the current price, it looks like right now they cost around $1.60 each. So each contract controls 100 shares. So with $1,600, I could buy 10 contracts controlling 1,000 shares instead of 100. This is a more conservative way to gain leverage. I'm betting the stock will rise, but I've got a comfortable strike price that's already near the money. Okay, the next option scenario is more aggressive. So we're talking about something that's a month away. And if I wanted to swing for the fences, I could buy the $17.50 strike calls. They're cheaper, maybe 50 cents each, but riskier. With the same $1,750, I could buy 35 contracts controlling 3,500 shares. But those only pay off if the stock keeps climbing fast. It's higher risk, higher reward. Here's why those calls can move so dramatically. As the stock rises, demand for those contracts explodes. Traders start pricing in future gains. So even if the stock doesn't hit my target, the option price itself can go parabolic during a run. That's why I don't have to wait until the expiration or even for the strike to be reached. I can sell those options early and take profits long before then. This is what makes options so powerful. They let you express conviction with timing and structure. When you combine that with Fibonacci levels and real-world catalysts, you're no longer guessing, you're trading with context. But all the context in the world doesn't help you when you're wrong. If something major happens, if a catalyst isn't reached, if for whatever reason trading starts to go the other way, the value of those options decays much quicker. So I only play options when I have a lot of conviction in the stock, in the chart, and the upcoming catalysts. So for Aduro, I keep the majority of my stake is held purely in shares. And on that subject, when we're at about $16 earlier last week, I went ahead and bought another 5,000 shares. So looking at the chart, I expected a pullback, but I wasn't sure we're going to have one. So I'll go ahead and say that was a poor trade on my part. I made up for it when the stock got down lower, but you can have all the chart information in the world. You can have great conviction in a company and you can still make a bad trade. Now, I bought those shares for $16. I'm looking ahead 2 years in the future. I don't think I'm going to have any regrets on buying them at that level. But if I would have waited till $13, I would have bought more and for the same money. So, all right. So whether you're holding shares or using calls, understanding the math of the move helps you trade with patience instead of panic. Fibonacci show you where you are in that rhythm, and options let you amplify that rhythm if you're confident in the story. Look at Aduro. The stock ran up to 1766, then pulled all the way down to around 1277. It is right into that 78% retracement zone. That's where fear peaked and where the next move started. Conviction doesn't mean chasing green candles. It means understanding where value really lies. So when the price found support and started to climb again, that's when conviction meets strategy. Fibonacci showed the structure, the fundamentals gave me confidence. Together, they told me it was time to look at options. An option is a contract that gives you the right to buy shares at a set price before a certain date. With calls, you can control the same stock for a fraction of the cost. In my case, 10 call contracts at $15 strike costs about $1,600 instead of over $14,000 to buy the same number of shares outright. Because I know the company and its catalysts, I'm not gambling, I'm positioning. Options let me express conviction efficiently. And if Aduro continues to rebound, Fibonacci tells me that the next wave could reach around the $20 to $22 range. That's how I think about it. Not chasing, but waiting for alignment, story, structure, and setup. Volatility isn't the enemy, and patience is. When you understand the math behind the move and the story behind the stock, options can give you leverage without losing control. That's not luck, it's preparation. Next time, I'll show you how to pick strike prices and expirations that match a catalyst. So thank you for watching, and remember, every pullback has a rhythm. Happy trading.